Hello everybody, what's going on? So today we need to have a serious conversation about SOFI. If you have been watching the charts lately, you have seen the volatility. You have seen the critics calling it's just another bank. And you have seen the price action gets pushed around by the macro data. Smart money is looking at something else entirely. Today I'm breaking down why the current fear in the SOFI is actually a massive disconnect from the reality, and why this week technical setup combined with major insider move suggest we are at a major turning point. We are going beyond the surface level to look at what this company is actually building while nobody is looking. But first, let's address the elephant in the room: Wall Street identity crisis with SoFi. Currently, the stock is trading at PE around 26. To the bear, they see a brick and bank and scream overvalued because traditional bank trade at PE of 5. But that's a fundamental misunderstanding of business model. SoFi isn't just collecting interest on loans. They are a vertically integrated fintech powerhouse. When you look at the technology platform, Galileo and Technisys, you aren't looking at a bank. You are looking at the AWS of fintech. And we are seeing a shift where risk on sentiment is returning to the market. When big money start looking for value and growth, they aren't going to buy the companies already at all-time highs. They are going to buy the ones that have been unfairly compressed. SoFi is at the top of that list. This week is a gauntlet of economic data. We have existing home sales, a flurry of Fed speakers, ADP, CPI, and PPI. The market is terrified of inflation staying sticky, which could delay rate cuts. However, at the labor data, we are seeing a 6.6% likelihood of a June rate cuts. But here's the kicker for SoFi. They have proven they can be profitable even in high rate environment. If rate stays high, their net interest margin remain robust. If rates drop, their lending business, specifically mortgage and student loans, will explode with new volume. It's a heads I win, tails I don't lose scenario that the market hasn't priced in yet. Now let's talk about the Friday surprise. Usually when a company drops new after hour on a Friday, they are trying to hide a disaster. But Anthony Noto did the exact opposite. He dropped a 250,000 buy order. Think about that. The CEO is putting his own skin in the game again. This isn't a guy who is worried about the next quarter. This is a leader who knows the internal metrics and sees a massive bargain. When the leader of the company is buying the dip with six-figure sums, it sends a clear signal to short sellers. You are playing with fire. Speaking of the shorts, with over 13% of the float shorted and day 2 cover sitting at 2.6. Any positive catalyst could trigger a massive short covering rally. Looking at the charts, the stochastic RSI is screaming oversold. We have been hammered below the 50-day and 200-day moving average, which has created a spring-loaded setup. We are watching for a break above the 10-day moving average at $16.54. I think that is going to happen today. It will break that level today or maybe tomorrow. If we clear that, the next stop is the 50-day at 17.32. Historically, when SoFi breaks these key levels, we don't just move 1 or 2%. We see 30% swings. The sellers are becoming exhausted and buyers are starting to step in at these S2 and S3 support levels. The floor is farming up. So what's the bottom line? Is SoFi a thrill ride like the theme park? Absolutely, but the best wealth is built by staying on the ride when everyone else is jumping off. I'm personally using this volatility to dollar cost average, whether it's through selling puts to get a better entry or just adding shares at these levels. The thesis remain unchanged. We are looking at a company that is systematically disrupting the financial sector, led by CEO who is doubling down on his own vision. The recovery isn't just a prediction for this week, it's the inevitable result of a high growth company finally being recognized for its true value. So stay patient, focus on fundamentals, and don't let the short-term noise shake you out of a long-term winner. And while the market treats SoFi like a bank, they have missing the flywheel effect. Most traditional banks spend a fortune to acquire a customer for just one product, a credit card or a checking account. But SoFi's secret weapon is their low customer acquisition cost, or CAC, because they offer everything from high yield saving to investment account and insurance in one app. They can cross-sell to existing users for particularly zero additional marketing spend. This is why their margins are expanding while other fintechs are struggling to keep the lights on. Every time Anthony Noto mentioned member growth, he is talking about more than just a number. He is talking about a lifetime of revenue from a single user. As the super app narrative gains steam with the mainstream media, we should expect a massive re-rating of stock multiple. And the correlation between SoFi and the crypto market, with Bitcoin holding key support level around $80,000, we are seeing a massive return of retail interest in digital assets. SoFi has been quietly positioning itself to benefit from the risk on appetite, unlike some competitors who are purely reliant on trading fee. SoFi uses crypto as a gateway to bring younger tech-savvy investors into their broader ecosystem. If Bitcoin break out towards new highs, SoFi won't just move because of sentiment. It will move because of increased platform activity and higher deposit inflows. We are seeing a conversion where the fintech world and the crypto world are becoming one, and SoFi is the bridge. Now let's look at what the 13F fillings are telling us. We are starting to see big money pivot from overextended tech giants into what I call value growth. When institution when institutional managers look at the broader market, they see a lot of companies trading at 100 times earning. Then they see SoFi, which is finally gap profitable and trading at a fraction of its future potential. On Friday, we saw heavy macro option play that suggests a pivot toward risk on asset. When that money moves, it moves fast. It's like a tide coming in. It lifts all the boats, and the boats that have been anchored to the bottom by the short sellers, like SoFi, tend to pop the hardest. We aren't just looking for a retail rally anymore. We are looking for the institutional stamp of approval that stabilizes the price for the long term. Think back to the early days of Amazon when people said they were just a bookseller. That is exactly where we are with SoFi right now. The critics are saying they are just a student loan company or just a bank. They are ignoring the infrastructure. By owning the tech stack through Galileo, SoFi is essentially taxing the rest of the fintech industry. Other companies literally pay SoFi to run their own apps. This is the ultimate positive ending narrative. You aren't just betting on a bank, you are betting on the infrastructure of the future of the money. That is a story that wins over a 5-year horizon, regardless of what the CPI print says on Tuesday.